One Up on Wall Street by Peter Lynch. The secret Wall Street doesn't want you to know. I want you to imagine something with me. Imagine that 30 years ago, you walked into a Dunkin' Donuts store. You would order your coffee, and while you waited, you would notice that the place was full, always full, every day, every week. People lined up. Employees were running from one side to the other. The tables were never empty, and you, without being an economist, without having studied finance, without knowing a single balance sheet, had at that time information that the most sophisticated analysts on Wall Street did not have. You saw reality. Now tell me, would you have invested in Dunkin' Donuts? Because Peter Lynch would have done it. And that, exactly that, is what makes this book different from any other financial book you've read or will ever read in your life. Welcome. Today we're going to dive into one of the most important, best-selling, and most transformative books in the history of personal investing. We're talking about Peter Lynch's One Up on Wall Street, a book that when I first read it, and I swear I'm not exaggerating, made me sit up straight in my chair and think, why didn't anyone explain this to me before? This is not a book of complicated formulas. It's not a manual for financial engineers. It is not boring economic theory. It's something much more powerful than all that. It's the field manual of someone who took $12 million, turned it into $14 billion, and did it while paying attention to things that we all see every day. But before you start thinking this is another get-rich-quick video, stop, breathe. Because what Lynch is going to teach you is something much more valuable than a trick. It's going to teach you to think differently. And when you change the way you think, everything else changes too. So, sit back, because what's coming is long, it's profound, and I promise that when you're done listening to this, you're going to see the world around you with completely different eyes. You're going to walk into a supermarket, and you're going to think about stocks. You're going to hear your neighbor tell you about a new restaurant, and you're going to ask things that you never would have thought of before. And that, my friend, is exactly what Lynch wanted when he wrote this book. Let's get started. Who is Peter Lynch? To understand this book, you first have to understand who wrote it, because this is not a book by someone who studied investments from a desk. This is the result of 13 years of war in the trenches of the most competitive financial market on the planet. Peter Lynch was born in 1944 in Newton, Massachusetts. At the age of 10, his father died of cancer, and his family was left in a difficult financial situation. To survive, young Peter got a job caddying on a golf course, basically carrying the bags of wealthy golfers. And there, as he listened to the conversations of these wealthy men, he began to become fascinated by something they constantly mentioned: stocks. With the tips he earned, Lynch began investing. He was 11 years old. His first action was that of an airline. With the time saved as a caddy, he managed to pay for part of his university education at Boston College. Then he studied an MBA at Wharton, which is basically the source of the largest investors in the world. In 1969, he joined Fidelity Investments, one of the largest fund managers in the United States. And in 1977, at only 37 years old, he was given the management of the Magellan Fund. When Lynch took the reins, the fund had $18 million under management. When he left the fund 13 years later, in 1990, that fund had $14 billion. $14 billion! With an average annual return of 29.2%. To understand what that means, if you had invested $10,000 in the Magellan Fund the day Lynch took control in 1990, you would have approximately $280,000. And the most incredible of all this, and it is something that he himself admits with brutal honesty in the book, is that many of his best investments did not come from complex analyses. They came from everyday experiences. Of what his wife bought at the mall, of what her daughters told him about fashion brands, of what he saw in the businesses in his neighborhood. And that is the central message of this book, one that, when you really understand it, changes absolutely everything. Lynch wrote One Up on Wall Street in 1989, at the peak of his career, and he did so with a clear purpose: to show that the amateur investor, you, me, any normal person with common sense, has real advantages over the great professionals on Wall Street. No small advantages, huge structural advantages, almost impossible to replicate from within the system. When I first read it, I remember having to pause on that part and read it twice, because wait, are you telling me that I, who don't work on Wall Street, who don't have a trading computer, who don't read 200-page financial reports every day, have an advantage over professionals? How? Why? The answer to that question is the heart of this book, and I'm going to explain it to you. The Common Investor's Advantage. Chapter 1. The Myth of the Invincible Expert. Lynch begins the book with a direct provocation. It says basically, if you think you need to be a financial expert to invest well, you've been lied to. Not only that, the financial industry has a huge interest in you continuing to believe that, because as long as you believe that you're incapable of making your own decisions, you'll continue to pay them commissions to do it for you. And here comes the first piece of information that will make you uncomfortable. Lynch shows with numbers that most investment funds managed by professionals do not outperform the market in the long term. In fact, in most years, more than 70% of active funds underperform the S&P 500 index. Less, with more commissions, with more complications, with entire teams of brilliant analysts. Why does this happen? Lynch gives several reasons, and all of them are fascinating. The first is what he calls career risk. Professional fund managers don't manage your money with the goal of maximizing your returns. They manage money with the aim of not losing their jobs, and that generates a completely different behavior. If a manager invests in rare, little-known stocks and that bet fails, he's fired. If you invest in the world's best-known stocks, Apple, Google, Microsoft, and fail, that's okay, because everyone was investing in the same thing. The error is understandable. It is a socially accepted error. Do you see the perversion of the system? The professional manager is incentivized to be mediocre, not to be highlighted, not to take risks, and that, in the long term, translates to returns that do not exceed the market. You don't have that problem. You don't have a boss that evaluates you. You don't have a board of directors looking at every decision. You don't have to justify to anyone why you bought shares in the small pizza chain in your town.
You can invest in what you believe in, withstand volatility without anyone pressuring you to sell, and wait as long as you need. That freedom, Lynch says, is your greatest advantage. The second reason is size. When Lynch managed the Magellan Fund with $14 billion, he could not simply buy shares in a small company. If he bought 5% of a small company, regulators would come down on him. The market movements that he himself generated by buying or selling were enormous. It was like trying to turn an aircraft carrier around. You needed miles in advance. You, on the other hand, can buy $10,000 worth of shares in a small, shiny company without anyone finding out, without moving the price, no regulatory issues. You can be fast, stealthy, and precise. And the third reason, which is the most powerful, the most emotional, and the one that Lynch emphasizes throughout the book, you live in the real world. You see the real companies. You use the real products. You feel the trends on your skin before they appear on any financial reports. And that, if you know how to take advantage of it, is worth gold. Chapter 2. Researching the company, not the market. Here, Lynch does something that I thought was great when I read it. He completely dismantles the idea that to invest well, you have to predict where the market is going. That is what economists do on television. Those predictions of the market is going to rise by 15% this year, or a recession is coming in the second half of the year. Lynch says, calmly enough, that this is useless. Not because it is impossible to predict, although it is also, but because it is not relevant. The direction of the market does not determine whether an individual investment will work or not. An extraordinary company can triple in value while the market is at all-time highs. A terrible company can fall by 80% while the market is at all-time highs. Lynch says he spent the early years of his career obsessed with macroeconomic variables, interest rates, inflation, business cycles,
and that it was almost completely wasted time. What really moved the needle in his career was when he stopped looking at the market and started looking at companies, one by one, company by company, understanding what they did, why they worked, what made them special, what could go wrong. That's what matters. And I'll give you a personal example that happened to me, and I think illustrates this perfectly. I remember at one point I started noticing that a friend of mine, who never talked about technology, suddenly started talking about a mobile payment app. Then another friend, then my mother, then the supermarket cashier. Everyone I know was using it. The company behind that app was still relatively small on the stock market. That was my sign. Not a financial report, not a Goldman Sachs analysis, but to see in real life how something was taking off. That's exactly what Lynch teaches you to do with this book. The Lynch System: How to Rank Stocks. One of the most practical contributions of this book, and one that has served me most personally, is the system that Lynch developed for classifying stocks, because not all actions are the same. Not all of them behave the same. Not all of them should be managed equally, and confusing them with each other is one of the most common and costly mistakes investors make. Lynch divides companies into 6 categories, and I'm going to explain to you each of them with the depth they deserve. Lynch's 6 categories. The first category is slow growers. These are large, mature companies that grow at about the same rate as the overall economy. Utilities, large telecommunications companies, some industrial companies. Lynch is not a fan of these stocks for the individual investor. Not because they are bad companies, but because they offer little potential for revaluation. You buy them mainly for their dividends, not for their growth. The second category is the stalwarts, or stable enterprises. They're the consumer giants that we all know: Coca-Cola, Procter & Gamble, Johnson & Johnson. They grow at a moderate but steady rate, between 10 and 12% per year. Lynch says these are your havens in times of recession. They're not going to make you rich overnight, but they're also not going to destroy your capital when the market gets nervous. The third category is fast growers, and this is where Lynch really gets excited. They're the small or medium-sized companies that are growing between 20 and 30% per year. They're the ones that can multiply your investment by 10, by 20, by 50. They're the so-called 10-baggers, which is the term that Lynch coined, in which means a share that multiplies its value by 10. When I first heard that term, 10-bagger, I thought it was something reserved for mathematical geniuses or high-frequency traders. But Lynch explains that most of his best 10-baggers were found in completely ordinary places, in shopping centers, on coffee conversations, on holiday trips. The fourth category is the cyclicals, or cyclical companies. Automobiles, steel, airlines, chemical industry. Their profits rise and fall predictably with business cycles. Lynch warns that these are among the most dangerous for the unprepared investor, because people tend to buy them when everything is going well, which is exactly the wrong time, and sell them when everything is going wrong, which is also the wrong time. The fifth category is turnarounds, or companies in recovery. They're the ones that have fallen on hard times, have lost a lot of value, and have the potential to bounce back. Lynch calls them the dead rising again. Chrysler in the 80s is his favorite example. If you invest well in a turnaround, the returns can be explosive, but you have to know how to identify which ones are going to recover and which ones are simply going to die. The sixth and final category is asset plays, or companies with hidden assets. These are companies that have assets on their balance sheet that the market is not valuing correctly. Sometimes they are land, sometimes they are patents, sometimes they are subsidiaries that are worth more than the entire company. Lynch found several of these in his career and explains that they require a different, deeper look that goes beyond the share price. Why does this classification matter so much? Because each type of action requires a different strategy. One mistake many investors make is to buy a cyclical stock expecting it to behave like a fast grower, or cling to a stalwart, waiting for the performance of a turnaround. Sorting well is the foundation of everything else. The perfect company, according to Peter Lynch. Now comes what I personally consider the most exciting part of the book. Lynch describes what characteristics the perfect company has, the company he would want to put his money into. And when you read this list, and I swear it's almost a list of absurd-sounding things, you begin to understand why Lynch saw the world in a completely different way than the rest. The perfect company, according to Lynch, has a boring name. Yes, boring. If the company is called Advanced Technology Microprocessors International, that's a problem, because it sounds so good that everyone is going to want to invest before the fundamentals justify it, artificially inflating the price. On the other hand, if the company is called The Boring Company, literally boring company, no one is going to pay attention to it. And that lack of attention creates opportunities. The perfect company does something boring. Sell socks, process industrial waste, manage funeral homes. Lynch owned shares in Service Corporation International, which operated funeral homes throughout the United States. Can there be anything more boring? Can there be anything more resilient to recessions? People don't stop dying when the economy goes badly. That business is almost immune to economic cycles. The perfect company does something unpleasant. Even better if it does something Wall Street analysts don't even want to look at. If it smells bad, if it sounds bad, if no one wants to talk about it at a gala dinner, it's probably underrated. I remember reading this part perfectly and thinking, this is contrary to everything we are taught. They teach us to invest in the glamorous, in what's in the news, what everyone talks about. And Lynch says the exact opposite. The glamorous already has an inflated price. The interesting, the novelty, what comes in all the media, that is the moment when the opportunity has already passed. The perfect company has something Lynch calls a lasting competitive advantage, a moat, a trench, something that prevents competitors from taking your business. It can be a powerful brand, it can be a patent, it can be the control of a scarce resource, it can be the network effect, but there has to be something that says this business is hard to replicate. The perfect company, employees and insiders, managers, buy shares in their own company. Lynch says that when the CEO uses his own money to buy shares in the company he runs, that's the most powerful signal you can get, because he knows exactly what's inside. If someone with full access to internal information decides to put his own money, that says more than 1,000 analyst reports. And the perfect company has institutions that ignore it. If 80% of the shares are in the hands of institutional funds and all analysts have it as a buy, the train is already passed. Lynch wanted to find the companies that the big funds hadn't yet discovered, or that they had ruled out for superficial reasons. And here's something that struck me deeply. Lynch says some of his best investments were in companies that big funds couldn't touch with a stick, not for financial reasons, but for image reasons. Can you imagine Fidelity announcing that it has invested in a cemetery? Public relations would be a disaster. But Lynch, as a results-driven manager, did it anyway, and he won. The red flags, what Lynch would never buy. Just as important as knowing what to look for is knowing what to avoid, and Lynch devotes a significant portion of the book to describing the types of companies and situations that make him run away. This section is pure gold, especially if you're just starting to invest. The first type of company Lynch avoids is what he calls the hot story in the hot industry. When an entire industry is on everyone's lips, when there are articles in every magazine, when your taxi driver gives you advice about it, the price already reflects as much optimism as possible. There's no margin for positive surprise. It can only disappoint. Think of the dot-com bubble in 2000, or in cryptocurrencies in 2017, or in the boom of SPACs in 2020 and 2021. When your neighborhood dentist starts investing in the same thing as all the hedge funds in the world, something is wrong, and that something always ends the same way. The second type of company Lynch avoids is the one that presents itself as the next something, the next Apple, the next McDonald's, the next Amazon. Lynch says if you have to compare yourself to someone to explain your business, it's probably because you don't have a unique enough business. The originals speak for themselves. Imitators need references.
The third is the whisper stock, the action of rumor, the one someone passes you in a bar telling you that they have privileged information, the one that circulates on internet forums with promises of multiplying by 100. Lynch says those stocks are like casinos. The casino always wins, and the one who loses is you. And there's another kind of company that Lynch especially loathes, the one that's desperately diversifying. When a company starts buying businesses that have nothing to do with its core business, that's a red flag. Lynch calls this de-worsification, a play on words mixing diversification with worse. When the sneaker company starts buying hotels, when the pharmaceutical company invests in real estate, that's a sign that the management doesn't know what to do with the money, or that it's trying to hide problems in the core business. This point touched me deeply because I had lived it. I remember seeing how a company I admired began to buy shares in businesses completely unrelated to what it was doing well. At first, I thought it was a sign of creativity and vision. Months later, the price had fallen by 40%, and the CEO was explaining at a press conference why those strategic acquisitions had not worked as expected. The teaching is simple but powerful. Great companies usually do one thing well. One, not 10. The art of research, what Lynch looks for before buying. Here, Lynch enters the territory that scares people the most when they think about investments: numbers, financial statements, the balance, the income statement, and he does it in the coolest way possible, by demystifying it all. Lynch says you don't need to be an accountant to understand a company's important numbers. The concepts that really matter are simple, straightforward, and anyone with a little common sense can learn it in a weekend. The metric everyone cites and few understand. The first and most important number that Lynch analyzes is the PE, or price-to-earnings ratio. It's basically how much you're paying today for each euro of profit that the company generates. If the PE is 10, it means that at the current price, it would take you 10 years to recover your investment with only the current profits. If the PE is 30, it would take 30 years. The higher the PE, the more expensive the stock is in relation to its profits.
But here, Lynch does something important. He reminds you that the PE should not be looked at in a vacuum. A company that grows at 30% per year may deserve a high PE because its future profits are going to be much higher than the current ones. A company that does not grow at all with a high PE is a trap. That's why Lynch uses what he calls the PEG ratio, or the ratio of PE to growth rate. A PEG below 1 suggests that the company is cheap relative to its growth. A PEG above 2 starts to sound expensive. Cash, the king nobody looks at. Another obsession of Lynch's is cash on the balance sheet, and debt. Lynch repeats this idea forcefully. A company with a lot of cash and little debt can survive just about anything. A company with a lot of cash and no debt is practically invulnerable. One of his favorite tricks was to look for companies where cash per share accounted for a significant portion of the share price. If a company is worth $10 per share and has $5 per share in net cash after debt is discounted, you're basically paying $5 for the actual business. That's what Lynch calls buying at a discount. And here's something that I always find wonderful. Lynch explains that this type of analysis can be done by anyone. You don't need Bloomberg, Reuters, or payment databases. The annual reports of the companies are public. The financial statements are there for anyone who wants to read them. Inventory, the most ignored red flag. Lynch also pays special attention to inventories in industrial or retail companies. If inventories are growing faster than sales, that's a red flag. It means that the company is producing or buying more than it sells, and that eventually translates into price cuts, lower margins, and potentially losses. It is one of those indicators that retail investors often overlook because it seems like a technical detail, but Lynch used it repeatedly to spot problems before they were reflected in prices. Lynch's rule of thumb when it comes to analysis is this: if you can't explain in 2 minutes why you're buying a stock, and that explanation can't be understood by your 10-year-old, you probably don't understand it enough to invest in it. This idea seems revolutionary to me. Because I live in a world where financial sophistication is confused with intelligence, where talking with technical words and complex models seems synonymous with knowing what you are doing. And Lynch tells you, no, clarity is intelligence, simplicity is mastery. Build and manage your portfolio like Lynch. This is the part where Lynch gets into how to build and manage a stock portfolio. And here are several ideas that are completely counterintuitive and change the way many people think about their investments. How many shares to have? The first thing Lynch addresses is how many shares to have, and his answer is surprising. As many as you find that meet your criteria. There is no magic number. If you find 3 extraordinary companies, you have 3 shares. If you find 15, you have 15. This goes against many classic personal finance tips that say that with 6 or 10 shares, you already have enough diversification. Lynch says diversification shouldn't be the goal. The goal is to find the best companies at the best price. If you have an extraordinary business at a reasonable price, why diversify into mediocre businesses? At the same time, Lynch warns against overconcentration, because no matter how well you've researched a company, you can be wrong. Things can change. An unexpected competitor may appear. Regulation may change. Maintaining some diversification is common sense, not cowardice. The 10-bagger, the philosophy of the long term. Lynch talks extensively about the psychology of the long-term investor, and he has an observation that when I heard it seemed brutally honest. Most people sell their winners too soon and keep their losers too long. He calls it plucking the flowers and watering the weeds. When a stock rises 30%, most feel the urge to sell and lock in profits. When a stock is down 30%, most hold on to it hoping it will bounce back. The problem with this behavior is that it removes from your portfolio the companies that are working and could continue to multiply for years, and leaves you with the ones that aren't. It's exactly the opposite of what you should be doing. Lynch tells stories of people who bought Walmart in the 1970s, saw the stock go up 50%, sold, and missed out on the subsequent growth of more than 100-fold. Or people who bought Starbucks when it only had 100 stores and sold when it reached 500. Starbucks came to have more than 30,000 stores. The right question is not how much has it gone up, but has the business changed? If the business is still as good as it was when you bought, or better, there's no reason to sell just because the price went up. And never sell for fear of the market. Lynch has a famous quote that I love: "More money has been lost preparing for market corrections than in the corrections themselves." The fear that the market will fall causes people to sell too early, miss out on the subsequent rise, and then buy back at a higher price. Bear markets, the greatest long-term investor's gift. This is arguably the most counterintuitive and most valuable lesson in the entire book, and it's one that honestly took me a while to digest when I first read it. Lynch says that bear markets, those times when stocks fall 20%, 30%, 40%, are not tragedies for the long-term investor. They're opportunities, huge opportunities. They're the equivalent of your favorite supermarket putting all their products with a 40% discount. Think of it this way. If you buy clothes and one day you see that everything in your favorite store is 40% off, what do? You probably buy more. You take advantage of the discount. You fill the closet. Why do we do the opposite with stocks? Why is it that when prices go down, most people sell in panic instead of buying more? Lynch says it's because of fear, because of the confusion between price and value. Because the market, in the short term, is a machine for creating panic and euphoria, not for valuing businesses. And here, Lynch makes a fundamental distinction that I think is the most important in the whole book: the difference between price and value. Price is what the market thinks something is worth today. Value is what that business really generates and will continue to generate over time. In the short term, the price can move far away from value, but in the long run, the price always tends to converge with value. Lynch lived through the 1987 crash, one of the largest single-day declines in Wall Street history. The Dow Jones fell 22% in a single day. What did Lynch do? He remained in the market. He continued to analyze companies.
He continued to buy the ones he found good at better prices. And a few years later, the market had recovered everything and reached new highs. Lynch's conclusion about bear markets is simple. If you have good judgment in selecting companies, bear markets are your best allies. They're the time you can buy at prices that under normal circumstances would be impossible.
But to take advantage of this opportunity, there is an essential requirement: not to need the money in the short term. Lynch insists that you should never invest money in the stock market that you will need in the next 1, 2, or 3 years. The stock market in the short term is unpredictable. In the long term, historically, it has always gone up. Psychology. The biggest obstacle is yourself. Lynch devotes a significant portion of the book to a topic that traditional finance books almost never touch: investor psychology. And it does so with a refreshing brutality. He says something that when I heard it made me laugh out loud and then think for days. The average investor doesn't lose money for lack of information, he loses it due to excess emotions. And he's right. Information is available. The financial statements are public, the annual reports of the companies are on the internet, the news of the sector is everywhere. The problem is not information, the problem is what you do with it when the market gets nervous. Lynch identifies several classic psychological errors of the investor. The first is the anchor effect, the tendency to focus too much on the price at which you bought. If you bought a share for 100 and now it's worth 60, the brain becomes obsessed with getting those 100 back, and that obsession can lead you to make bad decisions. The question that matters is not where the stock stands in relation to your purchase price. The question that matters is this business solid today? Does it have a future? If the answer is yes, the fall is an opportunity. If the answer is no, you have to leave, no matter what you have lost. The second psychological error is what Lynch calls the cocktail party theory. Lynch noted that there's a fascinating correlation between how you're treated at parties and whether the market is at the beginning or end of a bull cycle. At the beginning of a bull market, when stocks have gone up a little bit but people are still suspicious, if you say you manage money in stocks, people look at you with pity and change the subject. At the midpoint of the cycle, they start asking you what actions you recommend. And at the peak of the cycle, at the peak, in the bubble, people come directly to you to tell you about the stocks that they themselves are buying and from which they expect huge profits. And that last moment, when everyone is in, who is left out to continue buying and raising prices? The third psychological error, and perhaps the most profound, is the confusion between patience and passivity. Lynch is a passionate advocate of patience, to give good companies time to bear fruit. But that doesn't mean doing nothing. It means periodically reviewing that the investment thesis is still valid. It means knowing the company well enough to not panic when the price temporarily drops. Lynch says it's not the price drop that you should be worried about, it's the fundamentals drop. That sentence is, for me, one of the best summaries of the entire book. The complete process, from idea to purchase. In the final part of the book, Lynch assembles everything in one process, a step-by-step path that goes from the first spark of an idea to the final decision to invest. I think it is useful to go through it because it's where all of the above makes sense as a cohesive system. Step 1. The idea is born in real life. It all starts in the real world. You see a full business. You try a product that blows your mind. Your daughter tells you about an app that no one can stop using. Your company starts using a software tool you've never heard of before that does the work of 10 people. That's the spark. Lynch says the first filter is this: am I watching something real, or am I getting carried away by the excitement of a beautiful story? Step 2. Classify and understand the story. Once you have the spark, the first thing is to classify the company. Is it a fast grower, a stalwart, a turnaround, an asset play? This classification determines what you expect from the investment and how you're going to manage it. Lynch also asks that you articulate the story, the narrative of investing in 2 minutes or less. Why is this company going to be worth more in the future? What specific catalyst is going to drive profits up? If you can't tell it in a simple and convincing way, you don't understand it enough. Step 3. Go to the company. Lynch was famous for physically visiting the companies he was interested in. He went to the locals, he talked to the employees, he tried the products, he called suppliers and customers.
He did what is called kicking the tires, literally kicking the tires to see how solid the vehicle is. Can you do the same? Yes, you can go to the locals. Yes, you can use the products. Yes, you can talk to employees on LinkedIn. Yes, you can read customer reviews on social media. In the 21st century, the individual investor has access to more information than any investor in history. Investment forums, social networks, YouTube channels for analysis, free financial data tools. Lynch in 1989 would have been freaking out with the tools we have today. Step 4. The numbers that matter. With the idea validated, Lynch recommends reviewing a few key numbers. It's not a complete audit, they're traffic light signs. PE compared to growth, the level of debt, profit margins and their trend, free cash flow, the competitive position reflected in gross margins. If the numbers confirm the story you told yourself and the price is reasonable or attractive, you're ready to buy an initial position, not the whole position at once, a starting position that allows you to continue learning about the company with real money at stake and increase it over time if everything is confirmed. Legendary investments, when theory turns to gold. In the final part of the book, Lynch shares dozens of real-life examples of his investments. These stories aren't just interesting, they're the practical demonstration that his philosophy works. I want to tell you some of the most memorable. Dunkin' Donuts, the power of the obvious. This is the story that opened the book and that best illustrates Lynch's philosophy. In the early 1980s, Lynch went to a financial conference in New England. At halftime, he went out to get coffee and found it at a nearby Dunkin' Donuts. He noticed the queues, efficiency, the quality of the coffee, reasonable price, the happiness of customers. He went straight to investigate the company. He read their reports. He spoke with directors. He visited more premises. He found a company with excellent margins, manageable debt, and a clear expansion plan. He invested, and Dunkin' Donuts was one of his big investments of that era. The lesson: direct observation of a good business in action is as valid or more than any financial model. Chrysler, the turnaround nobody wanted. In the early 1980s, Chrysler was on the verge of bankruptcy. The government had to rescue her. The press thought she was dead. Analysts had it for sale. Lynch, on the other hand, saw something different. He saw a company that had brought out the Chrysler K-Car, a successful model, that had a new CEO in Lee Iacocca, one of America's most respected businessmen, that had debt but also had a huge asset, General Dynamics, its defense subsidiary, which alone was worth almost as much as the entire company.
Lynch bought, and Chrysler was one of its biggest 10-baggers. The stock multiplied by several multiples from the lowest point. The lesson: the most profitable turnarounds are those that occur in companies that everyone thinks are dead, but that have real assets and fundamentals that the market is ignoring. Taco Bell and the wife's investment. This is perhaps the most quoted story in the book. Lynch's wife told him she loved eating at Taco Bell, that it was great, that every time their children went, they asked for more. Lynch went to visit several places. He always found them full. He studied the numbers, and he bought shares. Years later, Taco Bell was acquired by PepsiCo in a deal that meant a huge profit for those who had invested. The teaching: the people who use a product the most are usually the first to see its potential. Listen to your surroundings. Pay attention to the consumption habits of real people. Peter Lynch's Golden Rules. Towards the end of the book, Lynch condenses years of experience into a series of principles that function as a decalogue of the intelligent investor. I tell you about them one by one, with the weight that each one deserves. The first rule: advantage over professionals. The individual investor who leverages their local, sector, or consumer knowledge has a structural advantage over fund managers. Use it. The second rule: time in the market, not market timing. No one knows when the market is going to go up or down. Trying to predict it is a losing game. What works is to enter when you find good companies at good prices and stay patient. The third rule: know what you have and why you have it. Every stock you buy should have a clear story, a specific reason why you think it's going to go up. If you can't articulate it, don't buy it. The fourth rule: check the business, not the price. What matters is not whether the price goes up or down every day. What matters is whether the business is improving, stagnant, or deteriorating. Review the fundamentals every quarter.
If they follow well, ignore the noise of the market. The fifth rule: profits are the engine. In the long run, a stock's price follows the company's earnings. A company that grows its profits in a sustained way will eventually see its price grow. No exceptions. The sixth rule: never invest money that you need. The market can fall at the worst possible time. If you need that money for the rent, for emergencies, to buy a car, don't put it in the bag. The seventh rule: patience is the most powerful weapon. Lynch says the long-term market has always rewarded the patient and disciplined investor, always, without a single exception in modern history of capitalism. The eighth rule: falls are opportunities in disguise. When the market falls and bad news fills all the headlines, if you have liquidity and identified companies, that's the time to act, not panicking. Conclusion: the book that changes the way you see the world. And so we come to the end of this journey through one of the most extraordinary books ever written on investing. But I want you to take something deeper than a list of tips. I want you to understand the full philosophy, the heart of what Lynch tried to convey with every page of this book. We live in a world that has convinced us that important things are complicated, that finance is the territory of experts, that markets are cryptic and inaccessible to the common citizen, that if you don't have a Wharton MBA, if you don't spend hours in front of screens with charts, if you don't understand financial derivatives, it's better to leave your money in the hands of someone who does. Peter Lynch spent his whole life proving that this is a lie. He lived in the real world, just like you. He had coffee at Dunkin' Donuts. He listened to his wife talk about Taco Bell. She saw her daughters shopping in fashion stores. And in every daily conversation, in every consumption experience, in every observation of the world around him, he found valuable information that Wall Street analysts locked in their glass offices with their 100 variable models could never have had. And what did that mean in practice? It meant an annual return of 29.2% for 13 consecutive years. It meant turning 12 million into 14 billion. It meant a career that made him the most successful fund manager in modern history. Not with privileged information, not with algorithms, not with trading robots. With observation, with common sense, with patience, with work. And the most beautiful of all of this, what makes One Up on Wall Street a one-of-a-kind book, is that Lynch wrote all of this not to brag about his accomplishments. He wrote it to give you, the individual investor, the average citizen, the tools to do the same. I'm asking you to do something with what you heard today. Not that you're going to buy stocks tomorrow morning, not yet. I'm asking you this week, in your everyday life, to start looking at the world with Lynch's eyes. When you walk into a business that's always full, ask yourself if it's public. When using a product you love, find out who makes it. When your company adopts a new technology tool, find out who's behind it. That first step, that change of perspective, is everything. Because once you start seeing the world like that, you can't stop doing it. And that is the true transformation that this book can generate in your life. Lynch left the markets in 1990 to spend more time with his family. He could have stayed, he could have continued to win, but he chose what was most valuable to him. And that decision, paradoxically, is also a lesson in investment. Money is a means, not an end. The real goal is freedom. And freedom is built brick by brick, decision by decision, smart investment after smart investment. Thank you for joining me on this tour of One Up on Wall Street. If this audiobook worked for you, please share it, because one of the most powerful concepts Lynch teaches is that financial knowledge is more valuable when it's shared than when it's saved. The more people invest wisely, the healthier the markets, the more capital flows to the companies that truly deserve it, and the more wealth is created for everyone. Until next time, and remember, the next 10-bagger is probably already in front of your eyes. You just have to learn how to see it.
Thank you so much, friend, for listening. Leave your ideas in the comments section so our community can grow by learning together. That's all for now. Until the next audiobook,